Hello and welcome back to my channel. Today I'll be discussing about NISM Series 7 Chapter 3. This chapter vastly discusses about the trade life cycle and the operations which are related for the same. So basically a trade life cycle refers to the series of steps which are involved in a financial market. So here we can see in the trade life cycle that the first step is placing of an order by the investor, client or the broker on the exchange. The second step which is taken is risk management and routing of orders through the trading platform. Then the order is matched and it is converted into a trade. At the end, there is a confirmation of trades. And in the last step, we have the clearing agencies which settles the trades. The trade life cycle consists of front office operations such as placing of the trade and conversion of the trade and routing of the order. In the middle of office function, we have risk management, and the back office functions consist of confirmation of the trade and clearing and settlement of the trade. So in the first step, that is placing of the orders are placed on a trader workstation, which is the terminal which is used by the members for trading on the exchange. And the exchange provides its own trading platforms to each of its members. So the TWS primarily consists of two kinds of information, which are trading members' own transaction information and market information. Another differentiating factor is that the exchanges have provided customized trading workstations as per each member. So we have different types of different types of trading workstations, such as computer to computer link, internet based trading, direct market access, security trading through wireless technology facility, automated or algorithmic trading. We'll be discussing about these in the further slides. It is mandatory for brokers to keep evidence of any trade, and this evidence can be kept in the form of a physical record written and signed by the client, telephone recording, email from authorized email ID, log for internet transactions, record of SMS messages, and any other legally verifiable record. And it is also said that when there is a dispute, the broker shall use the above mentioned records for the disputed trades. However, if there is an exceptional case where the broker fails to produce the evidence, the broker shall justify with reasons for the same and other appropriate evidence like post-trade confirmation, receipt of securities by client in respect of disputed trade, etc., shall also be considered. The brokers are required to maintain the records for a minimum period of 3 years as it has been told by SEBI. How orders are placed through the phone. So placing of orders through the internet or phone is a facility which is provided by stock brokers where the client can place orders over the phone for transactions in securities. Here there is a dealing desk which is appointed by call centers for the purpose of providing this facility. For availing this facility, the client is required to call on specific numbers which is provided by the stockbroker, and after calling they can put their orders through either email or through calling and or through their websites or otherwise. When the client opts for this service, he is required to answer the questions which are asked by the dealing desk executive, which may include the client user's ID, TPIN, and other details. Once this is done, the order is placed. SEBI has further instructed that wherever orders are received from clients through the telephone, the stockbroker shall use telephone recordings to record the instructions and maintain the telephone recordings as a part of its records, which can be used as evidence in the future. Internet trading takes place through order routing systems, which routes the client orders to the exchange for execution. So, through internet trading, any client sitting in any part of the country is able to use the internet as a medium and can trade through such a system. SEBI registers brokers can introduce internet based trading after obtaining permission from the stock exchange. Broker can also provide securities trading through wireless medium on wireless application protocol platform. There are some additional requirements which are to be met by the broker for providing securities transaction through wireless application platform. Direct market access. This is a facility which allows brokers to offer clients direct access to the exchange trading system through the broker's infrastructure without manual intervention by the broker. So, through this system, through direct market access, clients can directly place their orders on the system without any intervention from the broker. Some of the advantages of DMA are direct control of clients over the orders, faster execution of client orders, reduced risk of errors associated with manual order entry, greater transparency, increased liquidity, lower impact cost for large orders, better audit rates, and better use of hedging and arbitrage opportunities through the use of decision support tools or algorithms for trading. DMA had been set in place by SEBI in 2008 for the use of institutional clients. The facility of DMA is provided by the stockbroker and shall be used by the client or an investment manager of a client. A SEBI registered entity is permitted to act as an investment manager on behalf of institutional clients. In case the facility of DMA is used by the client through an investment manager, the investment manager is required to execute the necessary documents on behalf of the client. So basically, when there is any other entity who is acting as the investment manager, they have to execute all the necessary documents on behalf of their own clients. The exchange can also specify the category of investors to whom DMA facility can be extended. SEBI has introduced DMA facility to their clients after obtaining permission from respected stock exchanges. Brokers must specifically authorize clients or investment managers acting on behalf of clients for providing DMA facility after fulfilling KYC requirements, documentation, and carrying out necessary due diligence, records of which should always be properly maintained. Algorithmic trading is also known as automatic trading, and any order that is generated using automated execution logic shall be known as algorithmic trading. Stock exchange shall ensure that the broker shall provide the facility of algorithmic trading only upon permission from the stock exchange. The stockbrokers provide the facility of algorithmic trading shall be subject to a system audit every 6 months to ensure that the requirements which are prescribed by SEBI are being implemented. Such system audit will be carried by a certified system auditor. High frequency trading is a type of trading which is latency sensitive and is characterized by daily portfolio turnover and high order to trade ratio. Basically, there are four types of internal risk to protect the firm against market, credit, liquidity, operational and legal risk, to protect the financial industry from systematic risk, to protect the firm's customers from large non-market related losses, to protect the firm and its franchise from suffering adversely from reputation risk. The broker should have online risk management system including upfront real-time risk management in place for all orders placed on the exchange trading system. This system should have predefined limits for risk management such as order quantity and value limits, symbol-wise use order or quantity limit, user or branch order limit, order price limit, etc. Order matching and conversion. All orders which are entered into the trading system of the exchange are matched with similar counter orders and are executed. Order matching in the exchange is done on a price time priority basis. This means that the best price orders are matched first. If more than one order is available at the same price, they are arranged in ascending order. Best price is the highest price amongst all order, and the best sell price is the lowest price of all sell orders. Once the order is matched, it results into a trade. As soon as the trade is executed, a confirmation message is sent to the broker who entered the order. The broker in turn lets the client know about the trade through a confirmation through contract notes. All orders which have not been executed partly or fully can be modified during the trading hours. Before the order is matched, we can always modify the order. But once the order is matched, we cannot modify the order anymore because the trade has also already been converted. Trades done during the day can also be cancelled by mutual consent of the parties subject to approval of the exchange and as per trade annulment policy prescribed by SEBI from time to time. These generally occur due to order entry errors and are not a common practice. So, trade annulment can also take place but only after permission from SEBI and these generally take place due to any error which has been made in the order entry practice. Affirmation and confirmation. Institutional clients generally use the services of a custodian to assist in the clearing and settlement of executed trades in the cash or equity segment. Custodians are clearing members of the exchange and on behalf of their clients they settle the trades that have been executed through brokers. A broker assigns a particular trade to a custodian for settlement by entering custodian participant code at the time of order entry. Uh, the custodian is given the right whether they want to accept the trade or whether they want to deny the trade. So, upon confirmation by the custodian whether he would settle the trade, the clearing corporation assigns the obligation to the custodian. The custodian is bearing the risk by accepting the trade against the collateral that the institution who trades submits to the custodians for providing this service. While confirming the trade, the custodian verifies all the details. In 2004, SEBI had mandated that all institutional trades executed on the stock exchange should be processed through STP system, which is the straight through processing system. STP is a mechanism that automates the end-to-end processing of transactions of the financial instruments. It involves a use of a single system to process or control all the elements of the workflow of a financial transaction, including what is known as front, middle, and back office and general ledger. So basically, STP processes the transactions in just one pass. Hence, it is a much simpler method of clearing and settlement. Usage of STP orders to be processed, confirmed, settled in shorter time period and in more cost effective manner with fewer errors. Apart from compressing the clearing and settlement time, STP also provides a flexible cost effective infrastructure which enables e-business expansion through online processing and access to enterprise data. So a contract note has to be sent by the broker upon confirmation of the trade, and a contract note is a legal record of the transaction which is carried out on the stock exchange through a stockbroker. It serves as the confirmation of trade done on a day on behalf of a client on the stock exchange. Every stockbroker shall issue a contract note to its clients for trades executed on the exchange. and it is a legally enforceable relationship between the stockbroker and the client in respect of settlement of the trades executed on the exchange. Every trade on the exchange should be supported by a contract note. Contract note should be issued within 24 hours of the execution of the contract. They can be either issued in physical form or electronic form depending upon the mode chosen by the client. The contract note should be acknowledged by the client along with date in case of personal delivery. Stockbrokers are required to maintain proof of dispatch of contract notes in case of delivery of physical contract notes through post or courier. A digital signed electronic contract note (ECN) may be sent only to those clients who have opted to receive the contract notes in the electronic form. The acknowledgement of the email shall be retained by the member in a soft and non-tamperable form. The proof of delivery, that is the log report generated by the system at the time of sending the contract notes, shall be maintained by the member stockbroker, and the stockbroker should also maintain a bounce mail log showing details of the contract notes that were not delivered. So we have to show the contract notes which were delivered by maintaining a log report. The stockbroker member has to also not only keep a log report, but they also have to keep a bounced mail log, which shows the mails which were rejected or bounced back. Whenever ECNs have not been delivered or bounced back, members should send physical copy of the contract note to the client within the stipulated time. All ECNs sent through email shall be digitally signed, encrypted, non-tamperable, and shall comply with the provisions of the IT Act 2000. In case the ECN is sent through email as attachment, the attached file shall also be secured with digital signature, encrypted, and non-tamperable. The member shall simultaneously publish the ECN on his designated website in a secured way and enable relevant access to the clients. Email ECN can be sent through SMS or electronic instant messaging services only on registered mobile number as uploaded by the member on the exchange portal. The contract note should be unique, running serially numbered starting from the beginning of the financial year. Contract notes with weighted average price of the trade should contain the details thereon. Stockbrokers are required to maintain duplicate copy or counter foil of the contract notes. The contract note should be signed by the stockbroker or by authorized signatory of the stockbroker as per the guidelines specified by SEBI or exchanges from time to time. Clearing and settlement. Once the trade is executed on the exchange, the details are passed on to the clearing corporation. The clearing corporation initiates the settlement process of the executed trades. Based on the trade details from the exchange, the clearing corporation also determines the obligation of the members. In case of cash segment, institutional trades are sent to custodian, and in derivatives, custodian participant code trade sent to clearing member for confirmation. Based on affirmation, the clearing corporation applies multilateral netting and determines the obligations. The settlement process begins as soon as members' obligations are determined through the clearing process. The settlement process is carried out by the clearing corporation with the help of clearing banks and depositories. The clearing corporation provides a major link between the clearing bank and the depository. This link ensures the movement of funds as well as securities on the prescribed pay-in day and payout day. Instructions are given to the depositories and clearing banks for pay-in of securities and funds and payout of securities and funds. The clearing members have to ensure that they make available the securities to the clearing corporation before the pay-in day and time. Once the pay-in activities are carried out, the clearing corporation carries out payout of funds and securities. In India, we used to follow the T+2 rolling settlement in cash or equity segment. A SEBI circular dated 7th of September 2021 provided guideline for introduction of T+1 rolling settlement on an optional basis. After this, what happened? There were certain There were certain trading platforms which decided to implement T+1 rolling system in a phased manner. The first list of securities with T+1 settlement were introduced in the end of February 2022. T+1 rolling settlement was completely implemented in the securities market from January 27, 2023. Currently, all the securities traded in the equity segment, exchanges and clearing corporation follow the T+1 rolling settlement. In case of T+1 rolling settlement, the trades which have been executed on Wednesday shall be settled on Thursday, provided Thursday is a working day, with pay in and payout of funds and securities being completed on that very trading day. Front office operations. This is where the trade originates and the client relationship is maintained. Dealers and sales staff are considered front office staff. The main task of the front office is to generate orders and execute them. The front office operations also consist of client onboarding and registration, sales, and account opening. So basically, client onboarding means building a customer base. They have security sales agents and they spend time in networking and bringing on board clients. Sales. The sales force primary job is to call on clients and suggest trading ideas and communicate them to the clients. The job of the sales team also includes getting new clients to the brokerage firm. Account opening is the process of opening of accounts for new clients. The preference of the client shall be sought as part of client opening form. In case the documents are made available on electronic form, the log of the same shall be maintained by the broker or depository participant. Client opening form shall have two types, two parts, which are know your client KYC form and a few documents which will capture additional information about the client related to trading accounts such as bank details, demat details, trading preference, past actions and nomination details. Generally, a few standard documents which are a part of the account opening process are KYC forms and additional documents, documents stating right and obligation of the stockbroker and client for trading on exchanges, uniform risk disclosure documents for all segments and on or exchanges detailing risk associated with the securities market, guidance note which details do's and don'ts of the trading on exchange for the education of the investor, document describing the policies and procedures of the stockbroker, a tariff sheet which specifies the various charges, including brokerage payable by the client to avoid any dispute. In addition to the above documents, the client shall also be provided with the contact of the senior official, compliance officer in particular within the stockbroking firm, and the investor grievance cell in the stock exchange. With a view to encourage participation of new individual investors in the securities market, SEBI has prescribed a simplified account opening form, which is known as Saral AOF, for individual investors participating in cash segment of the exchange. KYC and other documents. KYC is acronym for Know Your Customer and is commonly used for customer identification process. Customer due diligence policy is a part of KYC, and KYC and CDD form a part of anti-money laundering process. The KYC process requires every SEBI registered intermediary to collect and verify the proof of identity and proof of address from the investor. Digital KYC. SEBI has allowed clients through digital medium, which is online or application based KYC, in person verification through video, online submission of officially valid documents and other documents using electronic or digital signature, including Aadhaar e-sign. Aadhaar shall be verified through UIDAI's verification mechanism. SEBI has registered intermediary on its own app for undertaking online KYC of clients. Requirement of in-person verification IPV. It is mandatory for all registered stockbrokers to carry out IPV of their clients. To enable the process of IPV, SEBI has allowed stockbrokers video in-person verification of an individual investor through their app. Usually, whenever you are opening your demat account through any stockbroker, they will request you access to their camera, and there will be a video verification of the same client. So the IPV takes place in a live environment. The IPV shall be clear and still, and the client in the video shall be easily recognizable and shall not be covering their face in any manner. The IPV process shall include random questions and response from the investor, including displaying the officially valid document, KYC form and signature, or could be confirmed by an OTP. The intermediary shall ensure that the photograph of the client downloaded through the Aadhaar authentication or verification process matches the investor in the IPV. The IPV shall be digitally saved in safe, secure, and tamper-proof, easily retrievable manner and shall bear date and time stamping. IPV shall not be required in cases where KYC of the client has been completed using Aadhaar verification of UIDAI and the KYC form has been submitted online, documents have been provided through DigiLocker or any other source which could be verified online. Some other documents required are the PAN card, proof of address document, proof of identity, which can be the driver's license or Aadhaar card. There is a KRA agency, Know Your Client Registration Agency, and the KRA is used for centralization of KYC records in the security market. The brokers or trading members upload KYC information with proper authentication on the system, and within 3 days from the completion of KYC, the KRA has to verify the same information. The KRA shall verify the necessary attributes of all the records within 2 days of receipt of KYC and within 3 days of completion of KYC process. CKYC is Central Know Your Client, which includes receiving, storing, safeguarding, and retrieving records in a digital form of a client. Stockbrokers shall, within 10 days after the commencement of account-based relationship with the client, file the electronic copy of the KYC with the CKYCR unique client code. This is a specific number which is assigned to each client, and this code acts in a way we can also say it is a type of an account number for the client. So each client is assigned a unique client code. All off-market transfer of security shall be permitted by depositories only by execution of physical delivery slip. Okay, so off-market transactions will be permitted by the depository when the physical delivery slip is signed by the client uh, electronically or physically, and the depository shall put in place a system of obtaining client consent through one-time password, which is OTP, for off-market transfer of securities from a client's demat account. Brokerage. Brokers use multiple commission schemes based on volume, based on slab or script-wise commission. The commission charges may differ for day versus delivery transactions. In order to be more transparent, SEBI advised members to display details of their brokerage to the investor in the order placement window on their IBT or W application prior to the placement of order. Brokerage rule for equity or capital market segment. Maximum brokerage that the brokers can charge is 2.5% of the trade value exclusive of statutory levies. If the value of the share is rupees 10 or less, maximum brokerage of 25 paisa per share can be collected. There is no minimum brokerage requirement specified. Brokerage rule for derivative segment. Brokerage rule for future is similar to the equity segment. In case of options contract, maximum brokerage can be 2.5% of the option premium or rupees 100 per lot, whichever is higher. Trading member can be a full service broker, discount broker, or an online broker. Commission charge may vary for different types of brokers. Full service broker charges higher commission, discount broker charges a much lower commission. Online brokers cater to a niche segment of retail clients. Uh, Commission charged is lesser than what would be charged for a client placing orders through a broker. Order management consists of entering orders, order modification, order cancellation, and order matching. There are different types of orders, such as market order, which is basic trade. A market order is where the trader purchases or sells the security at the market price. There are two variations on the market order without protection and market order with protection. Market order without protection means that the trades that are executed at the best available price in the market at that point of time. The market order with protection is a combination of market and limit order. Limit order involves setting the entry or exit price and then aiming to buy at or below the market price or sell above it. So basically, in limit price, we can set the price at which we want to enter and exit, and we can either it can be either above the market price or below the market price depending on the situation, whether we are buying or selling the trade. Stop order with stop loss triggers. This allows the trading member to place an order which gets activated only when the market price of the relevant security reaches or crosses a threshold price. Until then, the order does not enter the price. So in stop order, we have trigger price. Based on time condition, we have different types of order. A day order, which is valid for the day, and if the order is not matched during the day, the order gets cancelled automatically at the end of the day. IOC, an immediate or cancel order. This allows the trading member to buy or sell a security as soon as the order is released into the market, failing which the order will be removed from the market. Partial match is possible for the order, and unmatched portion is cancelled immediately. GTC, which is a good till cancelled order, is an order that remains in the system until it is cancelled by the trading member. Good till days or date order allows the trading member to specify the days or date up to which the order should stay in the system. At the end of this period, the order will get flushed from the system. Cancel on logout. If a member user entered order with COL, all outstanding orders of the user will get cancelled once the user logs out of the trader workstation. Currently, GTC and GTD orders are not available on the system as per SEBI directives. As per quantity, there are different types of orders which are disclosed quantity order. An order with a DQ condition allows the trading member to disclose only a part of the order quantity to the market. So here I have given an example. If there are if there is an order of 1,000 with a disclosed quantity condition of 200, will mean that 200 is displayed to the market at the time, and after the 200 are traded, another 200 will be automatically released onto the market until this happens 5 times and the entire 1,000 trades are executed on the exchange. Minimum fill allows the trading member to specify minimum quantity by which orders should be filled. So here we'll take the same example. An order of 1,000 units with a minimum fill of 200 will require that each order should be for at least 200 units. In other words, there will be a maximum of 5 trades for 200 each, or a single trade of 1,000. So in minimum fill, either of the things can take place: 5 trades of 200 each or a single trade of 1,000. All or none orders allow a trading member to impose the condition that only full order should be matched against. This may be by way of multiple trades. If the full order is not matched, it will stay in the books till matched or cancelled. Currently, all or none orders and minimum fill are not available on SEBI. There is another thing which is known as proprietary trading. So it is basically trading when the members are trading on their own behalf on the stock exchange. Process of order routing through the exchanges. So how the orders are processed. So the order is matched in an exchange which is done on the price time priority. The best price are matched first. If there are more than one order which arrives at the same time, they are arranged in an ascending order. And the best price is the highest price amongst all the orders, and the best sell price is the lowest of all the sell orders. Middle office operations consist of risk management and surveillance, and this is usually done by the help of margins. And margin is the amount which a clearing corporation levies on the stockbrokers for maintaining positions on the stock exchange. There are different types of risk for the members: operational risk, market risk, credit risk, legal risk, systematic risk, and technology risk. The back office exists for three reasons: confirmation, payment, settlement, and accounting. The back office monitors post market processing of the transactions. The back office is where the trade ends. Trade enrichment is performed automatically after each trade execution. In this step, all necessary details for clearing of trades and option contracts or the settlement of cash securities are added. For the purpose of back office operations, the back office system maintains masters relating to the brokerage rate, client-wise, goods and service tax, stamp duty, and securities transaction tax charge tables. Clearing and settlement process. Clearing houses are the entities which help in settlement of securities. All cash market settlements are done on a T+1 day rolling basis. Accounting is another function which is a part of the back office operations, and the stockbrokers are required to maintain books for a minimum period of 5 years. Certain other registers which are to be maintained are register of transactions or Sauda book, which is to include each transaction effected. This shows the name of the security, its value, rate, gross and net brokerage, and names of the client. Another book which has to be maintained is the client ledger. As the name suggests, it has details of all the clients and the transactions through the broker. The general ledger accounts for all the general transactions, including expenses, overheads, salaries, etc. The stockbroker and the depository participant are mandated to conduct comprehensive cyber audit at least once in a financial year. With this, we come to an end to chapter 3. And if you enjoy my content, please do like, comment, and subscribe. And see you in the next one.